Hello and welcome back to Financial Podcast. I'm Olivia, and today we're diving deep into some significant news that's been making waves across the business world, touching on everything from consumer staples to global economic forecasts. We're talking about none other than Procter & Gamble, the consumer products giant behind household names like Tide detergent, Pampers diapers, and Bounty paper towels. P&G recently made a major announcement that has many people, from employees to investors, paying close attention. Procter & Gamble confirmed its plans to significantly reduce its workforce over the next 2 years. The company intends to cut approximately 7,000 jobs, a substantial figure that represents about 15% of its current non-manufacturing workforce. When we consider P&G's total global workforce stands at around 108,000 people, these 7,000 cuts also translate to roughly 6% of its entire employee base. This isn't merely a minor adjustment, it's a strategic multi-year restructuring initiative designed to reshape the company for the future. So, why is a company as venerable and widespread as Procter & Gamble making such a decisive move? The core drivers behind this decision are multifaceted, stemming from a desire to boost productivity and cut costs. Procter & Gamble operates in what it describes as an increasingly challenging environment, and this has become a key factor in its strategic reevaluation. This challenging environment isn't just a vague corporate phrase. It encompasses tangible pressures like the impact of tariffs, which have led to higher costs for the company. Beyond tariffs, the company is navigating a landscape marked by slower growth in some areas and uneven consumer demand. Consumers themselves, according to P&G, face greater uncertainty contributing to this uneven demand. Furthermore, the geopolitical environment is described as unpredictable, adding another layer of complexity to global operations. And, of course, the rapid transformation brought about by technology is impacting nearly every aspect of daily life and business operations, compelling companies like P&G to adapt swiftly. The restructuring plan isn't solely about reacting to external pressures, it's also a proactive step towards creating a more agile, empowered, and accountable organization design. This involves making roles broader, teams smaller, and work more fulfilling and efficient. The emphasis on efficiency is crucial, and P&G explicitly states its intention to leverage digitization and automation to achieve this. This focus on technology signifies a shift towards optimizing operations and processes, potentially reducing the need for human intervention in certain areas, which in turn necessitates a workforce reduction. As part of this comprehensive restructuring, Procter & Gamble also plans to reevaluate its extensive portfolio of brands and products. While specific brands were not named, the company indicated that some may be eliminated or discontinued, and there might even be some brand divestitures. This strategic review of its product offerings allows P&G to streamline its operations, focus on its highest performing assets, and ensure that its supply chain is optimized for cost reduction. It's a move often seen in large corporations looking to shed less profitable or non-core assets to free up resources for more promising ventures. Despite the news of job cuts, the company maintains an optimistic outlook regarding future growth. P&G sees a significant potential for up to $25 billion in new growth opportunities. The company aims to capture this growth by investing in new product innovations and accelerating its innovation pipeline. This proactive investment signals that P&G isn't merely shrinking, but strategically repositioning itself to tap into emerging markets and unmet consumer needs, ensuring long-term competitiveness and value creation. From a financial perspective, P&G has generally demonstrated robust performance. The company reported stable revenue growth for several years, reaching $84 billion in 2024. It has also touted a sixth consecutive year of organic sales growth of 4% or better, along with an eighth consecutive year of 2% or better core EPS growth. However, the company did report a 2% decline in revenue in the quarter ending March 31st, which highlights the recent challenges it has faced. To counter rising costs, particularly those related to tariffs, P&G has been exploring price increases, although these were not expected to take effect until the summer. The announcement of these job cuts and the broader restructuring plan was shared with investors during a Deutsche Bank analyst call and a presentation at the 2025 Deutsche Bank Global Consumer Conference in Paris. The company's chief financial officer, Andre Schulten, and Chief Operating Officer, Shailesh Jejurika, outlined these plans, emphasizing that the changes will be implemented over the next 2 fiscal years. This 2-year timeline allows for appropriate sequencing of important innovation and operational projects, ensuring a smooth transition. While P&G's global headquarters are famously located in Cincinnati, where the company employs about 10,000 people, the specific impact of these job cuts by region or site is not yet clear. This is a common practice in large-scale reorganizations, as the company likely needs time to assess where the broader roles and smaller teams will best fit. However, P&G has committed to managing employee separations with support and respect, in line with its principles, values, and local laws. This pledge is important as it speaks to the company's approach to its human capital during times of significant change. The overarching goal of this restructuring is to ensure that P&G can continue to deliver balanced growth and create value for all its stakeholders: consumers, customers, employees, society, and shareowners. This holistic view underscores that the job cuts are not isolated events, but rather part of a larger, integrated strategy aimed at maintaining P&G's competitive edge in an increasingly dynamic and unpredictable global market. The company is actively seeking to expand into new segments and grow existing markets to best-in-class levels, a clear sign of its ambition despite the current economic headwinds. This strategic overhaul by Procter Gamble serves as a powerful illustration of how even the largest and most established companies must continuously adapt to remain relevant and profitable. The emphasis on digitization, automation, and a leaner organizational structure reflects broader trends across industries, where efficiency and agility are becoming paramount for survival and growth. It's a delicate balancing act for P&G, reducing costs and optimizing operations while simultaneously investing heavily in innovation and new growth opportunities. Ultimately, P&G's move is a testament to the ongoing evolution of the consumer goods sector and the need for companies to proactively manage their resources in response to global economic shifts and technological advancements. As we continue to monitor the implementation of this plan over the next 2 years, the focus will undoubtedly remain on whether these significant changes translate into the sustained growth and productivity that P&G is aiming for. That's all for today's deep dive into Procter & Gamble's strategic restructuring. Thank you for tuning in to Financial Podcast. I hope this discussion has offered valuable insights into the forces shaping one of the world's leading consumer goods companies. Please join me next time for more financial analysis and updates. Until then, stay informed and make smart financial decisions. Goodbye.